Today I'm going to talk about something called married puts. Before I do that, I need to say that the shares that I talk about today are for educational and informational purposes only. I'm not offering my opinion about whether something is a good buy or a sell. I would recommend everyone, before they make any investment, to seek out a qualified, conflict of interest free licensed financial advisor who can put the investments they make in a specific context related to their risk tolerances and their specific needs. So with that disclaimer out of the way, let's get to married puts. There is this widespread belief that investing in the stock market is a scary, dangerous thing, and that's maybe what causes some people to turn to real estate as a so-called safer investment. And that's a myth that I want to put to bed today. And I want to put that myth to bed today by talking about a strategy called the married put, or an investment idea called the married put. Married put strategy is a way to invest in the stock of a particular company, safe in the knowledge that the capital is going to be preserved. And given what's going on in the summer of 2014, capital preservation is the game at the moment. So what is this thing called a put? A put is an option contract, basically, that allows the owner of the put to sell a certain asset, or 100 shares of stock in this case, for a certain price, called the strike price, for a certain period of time. And after that period of time is up, the put is either exercised or it expires worthless. So that's, in a nutshell, what a put option is. Over the years, when I've talked to clients about puts, I've found a good way to help them get their head around the idea of a put is to think in terms of home insurance. So when you have a home, when you have a piece of real estate, you pay insurance on that home, on that house, and that insurance that you pay theoretically protects you from catastrophic loss. That's basically what the idea of a put option is as well. It's just another type of insurance. And so just like you'd pay your insurance company a premium every month, you will pay a little bit for that put option, the right to sell your shares back at a price that you have predetermined. But unlike an insurance policy, a put option is not going to have some cheesy insurance adjuster coming over to my house telling me why this particular disaster I'm not covered for. When it comes to put options, the share prices drop, you have the right to sell it at a higher price. That's the essence of it. So to use an example, if I bought today a put on Microsoft, for example, with a strike price of 40, that gave me the right to sell Microsoft anytime from now till the third Friday of January of 2015 for $40 a share. That's it. So no matter what happens to the share price of Microsoft, I get to sell my shares at $40. So a married put is a combination of the actual stock itself and a put option that you own on the stock. What we do with a married put strategy is we buy an actual stock that we like, and then we also buy something called a put on that same stock. So let me use a real life example. So it's July 22nd, 2014, and a company called Bed Bath & Beyond closed tonight at $61.05 a share. Now let's say I really like Bed Bath & Beyond. The management is ethical when I look at the financial statements. The financial statements look pretty clean in that there's not a lot of accruals thrown into the earnings. Great return on assets of about 16%, no debt. It has a great future in my view. So I want to buy shares of Bed Bath & Beyond. But because I think the market in aggregate is overvalued right now, this is a game where it's easy to make a mistake. I'm worried about losing my capital. My fear is that I really like Bed Bath & Beyond as a business, but I'm really nervous about the shares dropping precipitously from $61.05, where I would hopefully buy them on Monday morning, to say 30 or 40. So how can I solve this problem? How can I protect myself? Some analysts might wake up on the wrong side of the bed tomorrow and issue a bearish report on Bed Bath & Beyond, and that's going to drop the share price. The overall market, because it's ridiculously overpriced at the moment, might take a lot of things down, might drop precipitously, and that's going to take some great companies down along with the dreck out there. Just like what happened in the .com bubble, it got rid of companies like PetSmart, but it also brought down some great businesses like Microsoft and eBay and so on. So what I can do is, at the same time as I buy my shares of Bed Bath & Beyond at $61.05, say, I buy a put with a strike price of $60 a share, which gives me the right to sell my Bed Bath & Beyond at $60 a share, no matter what. Now I can choose different months. I can choose different expiration dates. I can go, if I'm worried about a short-term correction, I can buy puts on Bed Bath & Beyond that expire in November, or some that expire in January 2015. I can go for some long dated options that expire in January of 2016. So I can do a lot of things, but basically the idea is I will buy a put with a strike price of 60 at the same time as I buy my shares of Bed Bath & Beyond at 61.05. And that strategy, combining those two things, is called a married put. Now, why is that great? That's great because if Bed Bath & Beyond goes to $100 a share, that's fantastic. If Bed Bath & Beyond goes to $40 or $30 a share, it's not great, but I have the right, because of my put, to sell my Bed Bath & Beyond at a strike price, in this case of $60. No matter what happens, I can get most of my capital back. And like I said at the beginning of this video, capital preservation in the summer of 2014 is most of the game. So the consequences of a married put strategy is that you get most of the upside that a person who simply bought the shares gets. I say most because you had to pay a premium to buy the put, but very, very little downside. And so you're clipping your downside and you're keeping your upside almost unlimited. So that's what puts allow us to do. They allow us to invest with a lot less risk, and I mean a lot less risk. They give us most of the flavor and far fewer of the calories. That's the joy of the put option. So I've talked about the married put strategy with hundreds of clients over the years, and there's a few questions that have been repeated many, many times. One of them is, why would someone obligate themselves to buy my Bed Bath & Beyond at $60 a share when the chances are, not insignificant that it could plummet in price? Well, there's typically two reasons why someone would actually sell the put to me. The first one is they believe that Bed Bath & Beyond is actually going to rise in price, and they just want to collect a premium, because think about it, if Bed Bath & Beyond went from $60 a share to $70 a share, my right to sell it to someone at $60 a share would be worthless. And so they just collect the premium and drive on. The second reason they might want to obligate themselves to buy Bed Bath & Beyond, in this case, at $60 a share, in this case, is they actually think that $60 a share is a wonderful price. They're thinking to themselves, well, I'd buy it for $60 a share, no problem, but if somebody wants to pay me an extra $4 a share in order to obligate me to buy it at a price that I would love to buy it at, where's the harm in that? So those are the two primary reasons why someone's going to be on the other side of the put sale transaction. So that's it. That's a very brief introduction to married puts. Puts are actually a pretty complex instrument. There's a lot more to say about them, and I will be saying that in the next couple of weeks as I get further and further into options, because I think they're a great, safe way to participate and to invest in a way that's actually much, much safer than real estate, where risk of loss, there's nothing like a put option in the real estate game, I don't think. So take that, you real estate investors. As usual, thank you very much for watching, and thank you again to those people who've recently subscribed to us. I'm really quite flattered by the comments that I'm getting, and the large influx of subscribers we've had in the last month or so. So thank you very much for that. See you next time.